The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning and a warm welcome to Squawk Box Europe. I'm Juliana Tattlebaum with Karen Cho and Steve Sedgwick. These are your headlines this morning. The S&P 500 snaps a 7-day winning streak amid fears over the strength of the AI-fueled rally. But gold continues its surge, breaking through the $4,000 per ounce level.
Meantime, the U.S. government shutdown enters its second week with little prospect of a reprieve, as President Trump suggests he could deny back pay to some federal workers.
And BMW cutting its sales forecast for the year on the back of U.S. tariffs and lackluster Chinese demand, now seeing a dip on the year. I have a question. Good morning. Good morning.
Morning.
How are you?
Yeah,
How are you?
A big dangling question.
Well, no, it's a really simple question. What has changed in gold? What has changed? And do you know the answer is absolutely nothing. Say it again. No, that's war. That's a different song. But nothing has happened to mean that gold should be rallying as aggressively as it is now. Now, are there amazing reasons to own gold? I think there are. Are there trends that are multi-year that mean that gold is more exciting investment proposition? Absolutely. But at the moment, the rush into gold, and it is a rush into gold, the surge into gold is nothing to do with the bond market, is clearly nothing to do with the shutdown, because so many people on our show have said shutdown not affecting the size on the market. It is nothing to do with the geopolitics. It is purely about money flows. And I genuinely believe that. All the reasons why people are telling me to buy gold are the same reasons that people have told me to buy gold for absolutely years. The people who are saying it as well have already got gold, so I'm also very wary of the people who are telling me to buy gold. And again, I'm not saying one should not own the yellow stuff. I'm just saying there is nothing going on in markets at the moment apart from momentum and ETF flows of money that actually mean that gold should be bought now rather than a year ago, 2 years, 3 years ago.
Let me sweep in and pick up on gold rush. We know we've got a gold rush, but we thought it was in AI. I mean, that's where we thought the gold rush was happening. But it seems like we have a genuine gold rush in gold itself as well. What's changed? Some of the analysts forecast again. I mean, we saw it was only a couple of months ago, even a few weeks ago, where we were talking about getting past that 3,000 threshold to about a 4,200 number. Those forecasts are now changed. Goldman Sachs in the last 24 hours raising to $4,900 the target. So again, we were talking about it yesterday morning, whether the analysts will be forced to move on some of their forecasts, given how quickly the price has escalated already to their year-end target. So that happened very quickly in the trade yesterday. So that has changed in terms of a new bar for the market to work towards. Whether the catalysts are there, well, we keep on hearing about jurisdictions wanting to hold gold because of the debasement of money, the tariff issue, geopolitics. China, of course, looking for some settlement too on trade conditions. Gold is the currency of choice for some countries.
Yes, I'm not disagreeing with anything you're saying. 100% I'm not. I'm just saying all those reasons you mentioned, debasement, blah, 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 blah. That was, you could find that in textbooks going back 50 years.
So what has changed then? I think one factor here is the involvement of the retail investor. We've seen this across asset classes, especially in these momentum trades, AI being the most obvious one, but now gold also, all about the FOMO trade. And you are seeing retail investors buying those ETFs, which you mentioned, one of the key drivers of this surge we've seen in the price of gold. Well, let's get to markets, because yesterday we had a little bit of a different day to what we've had recently, and that was a down session for U.S. markets. All three of the majors ended the day lower. The tech-heavy NASDAQ pulled back about 0.7%. Lots of debate around where we are in the cycle, around AI, whether we're in bubble territory here, and those jitters seem to make their way into the trade yesterday. As for Asian markets overnight, a bit more of a mixed picture. Right now, all of the key majors are trading in the red. A little bit more mixed when you look across the broader region. But right now, Hang Seng down about 0.7%. The Nikkei 225 down about 0.33%. As for Europe, yesterday was a downbeat session. We had the Stoxx 600 losing about 17 basis points over the course of the day, the second negative session in a row. Now we are looking at a little bit of a bounce back, fairly muted though when you look at the magnitude of the moves indicated at this stage. In terms of bond markets, we are looking like this in terms of yields here in Europe. Yields lower for German, French, and Italian bonds. Here in the UK, you've got gilt yields moving slightly higher. That's the 10-year on your screens now. As for treasuries, this is what's going on in U.S. bond markets. We've got yields lower across the board. As far as the latest Fed commentary, former Dallas Fed president and Goldman Sachs vice chairman Robert Kaplan told CNBC it's reasonable to say the 10-year Treasury is not behaving as a safe haven, describing gold's rapid rally as a warning signal.
I would tell you gold being up almost 40% year to date, if that should be getting our attention. That's a red light that we ought to be paying attention to.
Let's get to Al Kadamol, who is fixed income portfolio manager at Mirabeau Asset Management, not a gold portfolio manager, I hasten to add. But Al, the bond markets, I'm sorry, even the OATs, I would suggest are relatively tame. Why is gold looking so wild at the moment? I think it is wild, I think it's fair to say, given the fact that all other asset classes appear to be behaving fairly beautifully.
Well, I think, one, you've got a lot of liquidity in the system. People need a financial asset to buy. And then, as they just said there, that, we have no safe haven. We've had incredibly high levels of rates volatility over the last 2-3 years. And people need something to buy, something that has a store of value or is actually working as a portfolio diversifier. So I think that's why commodities and gold has come through.
Do you believe then, and I think we've given gold a good run already this morning, do you believe then that fixed income specifically is not going to be performing the role that it's played in portfolios over, well, ad infinitum, over history, and it is not as safe as it should be?
I think it depends where you are on the curve. So fixed income, there's been a lot of talk about break even. That started to come back into conversations, back into research. So now that you're seeing proper downside protection, you're probably not going to see the volatility, let's say 10 years and shorter, that you have over the last 2-3 years. And the long end is where the fears are. The fears about fiscal is coming through. We've got rate cutting cycles going on, so the front end is anchored. It's unlikely that we're going to see the same returns over fixed income that we have for the last 2 years. Maybe high yield, 7-8% is too high going forward as we've corrected on spread, and you're waiting for this move in rates. We think it does still fit as the diversifier. We are at high levels of coupon, high levels of yield, which is attractive for total return investors. And as equities go higher, the correlation breaks down, and it will. The market has shown us over and over, when we get concerned about growth, fixed income, rates come down. When we don't have those data releases, then we focus on fiscal, then we focus on gold, we focus on other assets. Right. But every time, January or when we had the August payrolls, the immediate reaction is bonds rally.
Fiscal concerns have been cropping up and escalating around the world, whether you look at France, whether you look at the US, whether you look at the UK, and now when you look at Japan, given how the outlook has changed in the last 5 days or so. Have any of the bond market moves we've seen been disorderly, though, in your view?
No, if you look at Treasury volatility, so you look at the MOVE index, that's back to 2022 levels. VIX is relatively low. I think the move in French rates on Monday actually didn't set a new high. So we are wider than Italy. We are fairly wide versus bonds, but it didn't break out. It didn't set a new high. We've got a gradual falling out of love with the long end across the globe, but they haven't moved. I think certainly, is 5% 30-year, is that back on the table? Probably not. We were concerned January was the long end going to go to 6%? Probably not, because we've come through the start of the rate cutting cycle. Now that's confirmed. I mean, there have been points over the last 2 years we talked about rate hikes, but that's really off the table at the moment.
When you say 5% for the 30-year seems off the table now, concern around Fed independence doesn't seem like it's off the table now, and that clearly was one of the drivers of the long end in the last couple of months. And whilst the rhetoric around Fed independence has calmed in the last couple of weeks, certainly it could rear its head next year. You don't think that could drive the 30-year back toward those levels?
It's going to depend what the economic data is doing underneath. So when the economic data is fine or slightly slowing, then you have a worry that you're going to stoke inflation by being overly dovish. But then we saw with the September meeting, the number of dissents wasn't as many as expected. You know, the Fed officials seem to be well behaved. You know, these are professional people. This is their legacy. They're not going to come in and trying to destroy that. So you have to have faith that the system is there. You also have 12 voting members. So how many bad actors do you need in there to get a false move?
To the point around what the Fed does from here, there is a real risk that the Fed can pour fuel on the fire, that we've got this incredible rally, and we can all see it in plain sight. This rally that's unfolding is one of an enormous momentum at this stage. If the Fed were to ease from here, and there have been views pointed out overnight, BlackRock was saying, look, the degree of easing that you're seeing typically associated with a much starker weakening of the labour market, inflation and growth, none of which looks certain or even likely at this juncture. The US Federal Reserve has been pointing to fragility in the labour market, but there is a view, look, what we're seeing, much lower headline payrolls numbers, but that's also akin with the changes in the immigration rate. So unless we see some change in the Fed language from here, they still could be too dovish for this market.
Yes, I absolutely agree with that. You know, we're leaning towards the shorter end of duration. You know, the Fed meeting, they increased GDP, reduced unemployment, increased inflation forecasts, and cut rates. So we're at a point where you've got fiscal stimulus coming through in 26. You've got an end or a slowdown of tariff uncertainty. You've got all this pent-up demand. You've got economic actors just sort of sat on their hands. And now that rates have started to be cut, this should unleash people. We've seen, you know, a big LBO done on electronic arts. We've seen M&A picking up. So absolutely, this could be unleashing, as you say, a bit of rocket fuel.
What jumps out to me is that if each year that's transpired since the pandemic, we keep on thinking that we're going to get to easier economic scenarios, that the landscape is going to be much easier to read. But it hasn't been. If you look at the juncture right now, just as tricky as ever before, trying to get price stability. And even when it comes to asset price appreciation, there have been parallels drawn between Alan Greenspan's speech back in 1996, effectively pointing to a rational exuberance, to Jay Powell just recently talking about the asset prices being fairly highly valued. What signaling should we be getting from Powell about the risks in asset markets right now? Because let's face it, typically when you get a crisis, it's not always the economy that is the trigger for a crisis. It is rapid appreciation in asset prices.
Yeah, so a lot of that's been driven by, you know, the AI boom and the circular investment that's going on there. And, you know, to me, the thing that will bring that to the end is when we get an understanding of returns on that capex. But while it has been spent, you know, you talk about investor FOMO, but there's also company FOMO. If they're not spending, if they're not keeping up with the arms race, then that circle has to keep going. You know, you're gonna fall behind. So I think that, yes, valuations are high. You can see the momentum behind it. You can see the reasons behind it. But, you know, the underlying economic data isn't causing a crack. You know, we're at this point where you've got stimulus coming in and a labour market that's weakening. Now, we've talked in the past about long and variable lags of interest rate policy. So will the slowing that we've seen happen before we see that stimulus come through? And that's where the cross is going to come for fixed income and equities.
Al, for a lot of our viewers who are working out where to be on the curve, correct me if I'm wrong, because I was listening, I was trying to do something else at the same time as well. You said that you prefer the short end of the curve as well at the moment as well, but you also don't believe that the long end of the curve is going to revisit 5% again as well. So I'm talking about the 30-year, of course, there as well. Did I hear that right?
Yeah, that's about right. I think the range has moved down. You know, in the summer, before we'd started cutting rates, Trump was trying to fire Cook, he was trying to fire Powell, and there was concerns that complete loss of independence would de-anchor inflation expectations. Since then, we've had the bad payrolls, we've had ADP, now we've got the government shutdown, which will, you know, delay any kind of recovery. So in a slightly different market, you know, we're in an era that, you know, interest rates probably sort of grinding down rather than flying around.
Do I get enough bang for the buck then, owning 30-year paper at 4.7? Given what you just said, you're not too worried about the 5% level, which actually seems pretty bold of you because it's not that far away.
No, I know. So the break even on 30-year is only about 6 or 7 basis points. So the break even on 30-year isn't great on a 1-year time horizon. But on the 10-year, it's probably 50 basis points. So, you know, is the 10-year going to 4.76? No. You know, are we I think recession probabilities are too high. I think market has it about 30%. I think that's probably too high. But we have to respect that the labour market could crack. You know, the big thing that I'm watching is layoffs. You know, we're in a no hiring, no firing situation. August data came in on the JOLTS for layoffs about 1.1%. That's basically unchanged for 2 years. Yeah. If that picks up, you're not getting another job. You know, that's and if it doesn't pick up, then we're okay. Yeah.
Just the flip side of the trade, Europe, very quickly, politics are back in a big way. What do you do with the European yield curve?
Again, you know, you look for where you need carry. You look for high quality coupon income. That's our message at the moment: high quality coupon income while we still have it. Obviously, France moving wider. UK is very difficult to play. Bunds, it's an interesting one on bunds. We're torn because on the one hand, you've got fiscal stimulus coming through that we've never seen before, really, from Germany, which would push your bunds wider. But then economic activity is weak, so you know we're probably underpricing the chance of further ECB cuts. I mean, the chance of another cut is very low, and I think that probably should be a little bit higher. So you could be neutral on core govies, I would say.
Al, thank you very much for joining us this morning. We appreciate it. Al Katamal with us, fixed income portfolio manager, Mirabeau Asset Management. Outgoing French Prime Minister Sébastien Lecornu is due to report back to President Emmanuel Macron on the status of last-ditch talks to salvage his government. Lecornu has been holding negotiations with Macron's centrist alliances and the Conservatives over a proposed new cabinet and a budget. The Prime Minister shocked the government by handing in his resignation on Monday morning, less than a month into the post, after his cabinet picks sparked uproar from various factions. But Macron then tasked him with finding a way out of the political impasse by tonight. The French government's failure to form a cabinet and pass new legislation has also cast doubt on Macron's future. 3 of his former prime ministers, Gabriel Attal, Edouard Philippe and Elizabeth Borne, have all criticised the French president's handling of the situation. ECB President Christine Lagarde has also weighed in, saying EU institutions are closely monitoring France's political impasse and await a budget to be agreed.
President Trump has suggested that some federal workers on unpaid leave during the US government shutdown might not get compensation once they resume work. Well, doesn't it depend on their contracts? Isn't it that simple? Anyway, he said some people really don't deserve to be looked after. Wow. Trump said, to quote, ask the Democrats why some workers should not get backdated pay. This is interesting because the president actually signed a law in his first term ensuring that furloughed federal workers would get compensated after a government shutdown ends. This, as the shutdown enters its second week. As far as I'm concerned, this is simple. If you've got a contract that says you'll get compensation if you're furloughed, you get the money. If you haven't, then perhaps you won't. Isn't it that simple? I don't know. President Trump has suggested the United States could ditch the USMCA, trade agreement, in favour of bilateral deals with Canada and Mexico. His comments came during a visit to the White House by the Canadian Prime Minister Mark Carney. Referring to ongoing trade talks between the two countries, Trump said he thinks Canada will walk away very happy. Eamon Javers filed this report.
Something of a convivial atmosphere at the Oval Office today for the Mark Carney visit to President Donald Trump as the two leaders sought to paper over some of the tensions between the two countries that emerged during the course of the year on the issues of trade and tariffs, and of course President Trump's joke, or maybe not so much of a joke, about taking on Canada as the 51st American state. Ultimately, though, the president said today that the tensions between the United States and Canada are simply a matter of basic business competition. Here's what he said.
The problem we have is that they want a car company and I want a car company, meaning the U.S. wants a car company. And they want steel and we want steel. You know, so in other countries, they're very far away and there's no problem. You can compete and you can do. We don't like to compete because we sort of hurt each other when we compete. And so we have a natural conflict. It's a natural business conflict. Nothing wrong with it.
No indication from the White House after the meeting whether anything in particular was agreed to, but certainly leaders on both sides of the border will see this as a positive meeting between the two countries and maybe a step toward additional trade agreements. We'll wait for any details of those agreements to be announced by both sides. For CNBC Business News, I'm Eamon Javers at the White House.
Coming up on the show, we'll look at gold's rapid run-up and how investors are split as the precious metal crosses the $4,000 mark. Plus, UK steelmakers brace for the impact as the EU proposes fresh tariffs on the sector. We'll break down the measures. And Tesla shares slump as its new model release fails to impress investors. We'll discuss the outlook for the auto sector with Jim Saker at 8:30 London time.
Security company Verisure is set to go public on the Nasdaq Stockholm today, raising just over 3 billion euros. The company, which was founded in Sweden but now operates out of Switzerland, has priced its shares at €13.25 a share, in what would be the largest European IPO since Porsche went public 3 years ago. Remember the Porsche one? We were saying that was going to be the beginning of the IPO process, and then it was, Porsche is in its own lane. It's a very different company to the rest. Anyway, the CEO, Austin Alali, walked Sylvia through the rationale of moving ahead with the public listing of Verisure.
We obviously did a lot of, investor education, educating people about our company, also looking for feedback on how people appreciated our business model. And we got a great response. I think that investors, they see a long-term track record. They see more than a decade of uninterrupted double-digit recurring revenue growth. On the other hand, they also see the opportunity. They see the penetration opportunity. I think that combination of track record, of credibility, of a differentiated business model, but also a lot of growth ahead, convinced us that this was the right thing to actually go and take that story to investors.
So that's the right thing for your company. But if you take a step back and look at the broader picture in Europe, amid the several IPOs that we are now witnessing, particularly in Stockholm, in fact, what do you think the European political scene needs to do to keep up this pace of IPOs?
I think it's always about high quality assets. I think in any market conditions, investors are always going to be looking for companies that have a strong combination of credibility, of track record, and of potential ahead. This is also a business that's very resilient, remember. Security, it's a very important service. It's very sticky. One of the things that differentiates Verisure is we've got the lowest attrition, for example, in our industry, and one of the lowest among any consumer subscription service that you would study. That combination of potential and resilience, we think, is very attractive in all market environments, especially this one.
UBS is the latest investor to reveal more details of the impact of the implosion of Ohio-based auto parts group First Brands, which declared bankruptcy earlier this month. The Swiss lender's private credit arm, UBS O'Connor, said that almost a third of the exposure in one of its funds is tied to the group. Now, overall, UBS has more than $500 million worth of exposure to the company's debt and invoice-linked financing. I think this story, when you looked at the headline, this was a story the FT was running on their front page this morning. It certainly caught your attention. I don't know about you guys, but once looking into the detail, this is basically, just one investment gone
you
wrong.
You spent the whole article not dumbing down, sorry. The headline, I agree, 30% exposure. It's like, wow, 30% UBS assets. No, hang on, I read, and actually it's only $500 million. Yeah. I actually just checked something. Total UBS assets as of June 2025 are $1.669 trillion US. I'm not saying this isn't a big deal. I'm not saying there aren't going to be credit losses. I'm not saying it doesn't look like UBS's O'Connor's Rystone does look like it's on the hook for some of this stuff as well. But it's not Greensill Capital. It is not Barings as it was at the time. It's not Lehman Brothers. It's a big deal, but I wouldn't suggest it's going to be a deal breaker for UBS.
I think it's what it signals. And if you just reverse several months to where we had a conversation about how this business should be run, we know it's a huge weighting in Switzerland. The exposure of this bank now is very significant to the Swiss economy. So if there were to be a different story where the exposure was much greater for UBS and it completely got wrong the exposure to a company, then there is blowback, not just for UBS, but also for Switzerland. So I think it's the signaling of how did it get this particular one wrong? Could there be more bad eggs in the basket? And what is the size of exposure to any other potential bad eggs? It is sort of a rewind back in time about the risks of certain exposures and the risk of creating a behemoth in Switzerland.
Yeah, but the evidence is there. There's a great the FT piece is really good. I know CNBC have done some good work on this one as well. Olaf Storbeck, Julia Steinberg, Robert Smith and Mercedes Rule. I'm just giving the journalists full credit there as well, because I'm about to read a part of the last paragraph. FT copy. In January 2023, O'Connor provided investors in its funds with a case study of a North American auto parts manufacturer. Again, the copy says that it appears to be First Brands. Etc., etc. The case study disclosed that O'Connor was earning, and this is the clue on how risky it was. The case study disclosed that O'Connor was earning a 17% yield, 17% yield on 60-day investments linked to the company's supply chain. There is risky stuff out there, and this was fully disclosed. If you're earning 17% on 60-day investments, I think everybody out there, every one of our viewers can work out this is at the riskier end of their lending portfolio.
This is how it works. This is how private credit works in large part. Private credit and historically...
That is the great warning, by the way.
Yeah.
That is the great, great warning for all of those retail and asset managers and everyone who suddenly decided private credit is the greatest thing since sliced bread. If you don't know what you're investing in, but you're just blindly going into private credit, this is the great warning.
I thought that was actually where you were going to go, Karen, when you said this, this is actually more of a signal. You can think about it as a signal for UBS, but you can also think about it as a signal for private credit and private credit markets. This is a reminder that, this is a high risk, high reward part of the market to be in. And I think this whole First Brands ordeal reminded Wall Street that private credit is a risky business. As much as they have progressed, private markets, private credit funds have progressed in recent years to do more investment grade work. The bread and butter historically was doing the work that banks didn't want to engage in.
And that was a warning I had at a recent banking conference about the lack of collateral also given in some of these lending deals. There's really nothing to back it up. Very small lending houses as well that are really on the hook if something goes wrong. But to the point around signaling, I mean, there have been warnings for many months now about very lax credit standards that are happening yet again. So we have one company, and it was Tricolor the other week as well. Don't forget the ratings agencies had given them a clean bill of health. So I think effectively there are issues out there for some of these big institutions to rake back over, do some due diligence on the companies they've lent to.